we can withstand short-term volatility. The important thing is sustainable returns over the long term. And so therefore, we need to have a portfolio that is resilient across different macroeconomic environments and at the same time allows us to achieve our return objectives that we are sort of targeting.
I'm Jim Haskell, editor of the Bridgewater Daily Observations, and I'm once again coming to you from Singapore. Portfolio resiliency, and I want to define that, meaning the ability of a portfolio to withstand multiple different environments with relatively consistent performance range. That's a goal that most investors would like to achieve. But what does portfolio resiliency really mean for investors that invest primarily in equities, whether they be public companies or private companies? Is it really possible to construct an equity portfolio that can be diversified enough to be truly resilient, particularly during bear markets? To discuss this topic and more, including the respective thoughts on current investment opportunities, I'm joined today by Rohit Sipahimalani, CIO of Temasek Holdings in Singapore, and Bridgewater co-CIO Bob Prince. So Rohit, welcome. Bob, welcome.
Thank you.
Thanks, Jim.
Let's start with you, Rohit. For our listeners, maybe just elaborate a little bit and explain the kind of investing Temasek does.
So, Jim, as you mentioned, we invest primarily in equities, both public and private. We take concentrated positions with the idea of generating sustainable returns over the long term, part of which is used by the government as a source of revenue in its budget. Now, when we were set up in 1974, the government initially transferred shareholdings it had in companies it owned to Temasek so that it could be run commercially. And even today, 40% of our portfolio is in these Singapore headquartered companies, most of which we control. Another 10% is seeding various asset management companies. And then half our portfolio is invested globally. 60% of it is private and 40% is public. But important to know that we invest out of our balance sheet and so therefore need to recycle our capital to make new investments.
And so, given that you are essentially an equity investor, either public or private, this notion of portfolio resiliency is an important one. So how do you think about resiliency when really you're investing in one asset class?
So clearly, you will have volatility in equities, and we can withstand short-term volatility. The important thing is sustainable returns over the long term. And so therefore, we need to have a portfolio, particularly because it's so illiquid, that is resilient across different macroeconomic environments, and at the same time allows us to achieve our return objectives that we are sort of targeting. So we want our portfolio to be resilient across, let's say, different growth and inflation environments. And we found that one good way of measuring that for our companies is to look at their earnings volatility over the last 5 years and compare that with the top quartile of the MSCI ACWI in terms of the lowest earnings volatility. And we found that this group of companies with the lowest earnings volatility tends to be more resilient and have shallower drawdowns during downturns. And at the same time also delivers higher returns as long as they have positive growth. Now, that's obviously a backward-looking way and to see how the portfolio of these companies have managed different environments. But we also applied a forward-looking lens, looking at the top-of-mind strategic issues we're concerned with over the next few years. So in today's environment, it would be things like, will this company be negatively impacted by AI, the green transition, or US-China conflicts, more generally geoeconomic fragmentation? And again, these companies should be resilient from that perspective. Now, that's all from a bottom-up company-wise perspective. And then we look at the portfolio as a whole in terms of resiliency. And we do it in two ways. One is that we do stress tests across different shocks that we foresee. So example, major cyber attack globally or US stagflation and so on and so forth. And we look to see what the impact on the portfolio would be. Now, clearly, as I said, there will be sharp drawdowns because of the rise in risk premiums. But what's more important to us is what is the permanent impairment during these shocks in terms of impact on cash flows, current and future. And that's what we check for resiliency and see that, are we comfortable with the level of permanent impairment in these scenarios? And the final lens we look at is liquidity of the portfolio, because we need to have enough of our portfolio in either liquid securities or assets generating recurring income such as dividends, so that we have the liquidity to withstand shock environments and also, frankly, to change our portfolio a little bit to the extent we see changing regimes.
So you've described an approach when you look at the bottom up and how you screen out.
Yeah.
You've talked a little bit about the top down. What are the other ways, though, you get diversification? Do you believe in geographical diversification? Are there other ways that you can sort of take these return streams and get even more resiliency out of them?
So while we have concentrated individual positions, as you said, geographic diversification is important because different countries have different economic cycles and may be impacted by different things. I mean, so for example, I mean, if the US has done really well over the long term, but had we been only invested in the US from 2000 to 2010, we would have done very badly. Or for example, China, which we did really well, which is the best performing market from 2004 to 21. In the last 3 years, if we were only in China, we would have been hit very badly. So clearly, we look at diversification from that perspective. Even in individual counters, we want to take concentrated positions, but we have to look at some diversification across the portfolio. Geographic diversification clearly is one, sectoral is the other. And the last thing about how we manage the diversification side of it is that we invest a lot of our investment to get our returns alongside 4 major trends around digitization, sustainable living, longer lifespans, and changing nature of consumption, especially in emerging markets. But these trends also are more growth oriented. And so therefore we have to make sure that while we're investing in them, we're also investing in a sufficient number of high cash flow generating companies and ones that are giving us recurring dividends to sort of balance that. And then also it helps that most of our Singapore-based companies have more of a value bias. So it just creates a little bit more of a balance in the overall portfolio as we look at investing alongside our trends with returns, but also have a Singapore portfolio and then this segment that we consciously invest in what we call our income portfolio, which is high cash flow generating and giving us recurring income.
Would you say that most of your time allocation is just actually at the portfolio construction level, maybe probing how each group is doing and so on, but making sure at the overall portfolio level that you have that balance between the various different things, whether it's your Singapore investments, which tend to be more value oriented, or these 4 criteria you're talking about, which is more futuristic but more growthy, and you have your venture side too. You have to make sure you're balancing the portfolio to try and get that overall resiliency you're looking for.
Yes, I mean, it's obviously very critical from that perspective, but ultimately we are very much a bottom-up investor. So it's relevant in terms of how we allocate capital as a part of our investment plans. It's relevant in terms of when teams come with their pipelines, and we sort of discuss it with us on a regular basis, where we guide them, look, we need to shift a little more here, a little more there. But ultimately, we invest based on bottom-up things that come up from our teams.
Yeah.
And so we can temporarily move away, but then we are very conscious if we're moving away from where we want to go, then direct the teams in areas or allocate capital in areas which we think would strive that balance a little more towards where we want to go.
And then when you look at the sort of the target number of names you have in your portfolio, you're managing a big portfolio. What is the number of names or the range of the number of names you would be comfortable with?
So today we have a few hundred names in our portfolio across public and private. The number is probably a little higher than we would ideally like it to be. And that's part of it is because we also invest in innovation in early stage companies, which by definition are not resilient, but the ticket sizes there are small. So the number of companies tends to be large. And the idea is to come into these companies early if we think they can be breakthrough companies and then double down on them, as they progress. So that's why we do it, but clearly there'll be a lot of them which won't work out. And so therefore we cap our exposure again in terms of resilience to these early stage companies to be not more than 6% of our portfolio. And again, it's not the typical VC Series A or seed. It's usually Series C and later, but it is early stage and not resilient. So the number of companies, sounds big, but it partly gets distorted by these companies.
That's great. So Bob, let me bring you in here because, the term portfolio resiliency has been on your mind for quite some time. It's a lot of what you talk about around the halls of Bridgewater, and you heard Rohit's approach. Maybe briefly describe how you think about portfolio resiliency, particularly in the equity space.
Well, there's a lot of philosophical overlap between what Rohit and Temasek are doing and what we're doing. But I think we're both drawing from our unique core capabilities. And so for us, it really started maybe a decade ago or a bit longer, where we recognized that to really understand an economy, you have to understand all the parts and how the parts add up to the total. And so we built what we call equities bottom to top as a core infrastructure capability, which enables us to essentially take GDP and distribute that down to all the companies, or take all the companies and roll that up to GDP. That also then allows us to take advantage of our macro capabilities in structuring and engineering portfolios. So that was a bit more than a decade ago. And starting around 2020, when bond yields hit, basically zero, and essentially there was no bond yield, and the role that bond yield would typically play as a long-term stable return source didn't exist, right? So we started to think about, is there a way that I can structure and engineer an equity portfolio to do some of what a bond portfolio might do, which is that more reliable long-term return, though at a higher level given the equity risk premium. And a key step figuring that out is just recognizing, well, obviously a core feature of a bond is a stable coupon. So if I started with equities and I just separated the cash flow stream from the pricing, and I understand the relationship between the cash flow stream and the macro environment, could I build a portfolio of a highly stable cash flow stream on that basis? And then second, deal with the price action, right? And it turned out that you really could. You could build actually a really amazingly consistent cash flow stream. They gave you the resilience through the downturns that you're talking about, and gave you the advantage of compounding over time, which actually ultimately was a moderately higher cash flow stream because of the compounding characteristics. So that was really the starting point for us. But it also led to the recognition of the importance of the time frame in building a portfolio, which is when you're thinking about, let's say, a quarterly return is dominated by the price. The cash flow is a reference to the price, but the company doesn't really earn very much money. It's a very small amount. So the duration of the cash flow is essentially zero. The duration of the price is very long. But as you extend the investment horizon out to 10 years, you get a compounding of the cash flow stream, which effectively gives it a 10-year duration, while the volatility of the price is reduced over time. And so over 10 years, the cash flow stream is really dominating the long-term returns. So by separating the cash flow stream from the pricing and thinking independently about the drivers of short-term returns and the drivers of long-term returns, you can start to engineer a portfolio that really does both. And the way that we do that is it's really kind of three steps, where the first thing that we're doing is creating what you might think of as a portfolio of equities that's a storehold of wealth. And it's sort of the top 40% of the market in terms of stable earnings, stable revenues, and strong balance sheet. And we have multiple ways of assessing that, some of which are macro, top down, some of which are companies bottom up. And so you're essentially filtering out 60% of the companies that probably don't have the ability, or at least it's a questionable ability, to get through those difficult times, and building a portfolio that's going to have a sustained cash flow to investors through all times. And so you can think of those as your compounders, right? Reliable compounders that's a storehold of wealth over a long period of time. The second stage in our process is to take that set of companies and do kind of a classic valuation within that group. So high free cash flow, high risk premiums, which gives you the ability to buy the ones that have been sold off that still have a favorable scenarios. And so that adds another layer of return, but it also adds another layer of resilience to the portfolio. And so by the time you run those two processes, your kind of upside capture of the stock market is roughly 1.0, but your downside is almost like only 65% roughly of the equity down market. And then the third step is that recognizing that the portfolio that you built still has a vulnerability, particularly in the short run, to macro conditions, discount rates, risk premiums, the market's discounting of growth, which may not apply to the companies that you hold. There's a macro overlay at that stage. And so that particularly is beneficial for neutralizing the volatility of the shorter term returns. So essentially formulating a cash flow stream that provides a cushion and less economic exposure in the short run, but also stabilizes long-term returns, and a macro overlay that further helps you deal with the shorter term influences of the macro environment on the pricing of those equities.
And just like I asked Rohit, once you establish this portfolio, other ways to essentially increase the consistency. So geographical diversification, other factors. What would you say to those other things?
Well, the macro overlay is a really an important part of it. And so it's very targeted to down markets, right? And so because typically, in a down market, all stocks fall together. So security selection is never really going to completely eliminate that problem. And rather than, let's say, shorting individual stocks as a way to try to neutralize that, it's just cleaner and more transaction efficient with lots more liquidity to actually go directly to the source of the macro influence that's causing that. It could be a rise in interest rates, it could be a spike in risk premiums, right? So utilizing the more liquid markets that may not be an equity market, right? It may be, like I said, it may be hedging interest rate effects or credit spread effects, but going directly to the liquid markets that are driven by macro conditions to neutralize that impact. And of course, that's really drawn from our core capabilities of macro. And so that's, I would say, the main thing that we're doing. Obviously, we're also doing global diversification. So going back to the equities bottom to top, we have the ability to run that really across the world in half a dozen countries. And so that also is a feature that gives you the ability to take advantages of different conditions across countries and diversify that away. There's pretty big differences in liquidity across countries, of course, but you just take that into account.
Last question, which is that you look at the global landscape today, you have a US market in the public realm that's dominant in terms of its market capitalization and its relative returns, but you also can go far outside that. You can go pretty much anywhere. Where do you see the best opportunities today as you look at portfolios within this resilient framework?
So I'd make the point that, look, resilience is important in terms of making sure we have stable returns, but we also have a return target, right? So which is why we're comfortable with 60 to 70% being resilient and saying there will be 30 to 40% where we will target higher returns and maybe with a wider cone of outcomes. So, I mean, resilience without the other part isn't sort of that relevant. So, and then in that context, we're very much bottom up stock pickers. So, well, the US market may be expensive as a whole, but we may find some opportunities there. Today, even in the private market, since liquidity is at a premium, a lot of funds, private equity funds, are looking at doing single or multi asset continuation vehicles. Sometimes that can give you access to some of their best assets. So you can identify them, they have a clear track record, and actually with pretty attractive returns. So that's an opportunity that we're looking at, which we historically haven't spent much time on, but we're actually looking at actively today. There may be other segments of the market outside the Magnificent Seven or really big tech, which actually are trading at reasonable valuations. So we've got to really look at it bottom up. And actually, the US is one market where we still find attractive opportunities. We opened our office there only 10 years ago. So we're probably underrepresented compared to where we want to be and looking to increase that. The other market we find structurally very attractive today is India. Again, not surprisingly, it's an expensive market. But again, we find, depending on the segments you're looking at, so if you look at the financials today, particularly the banks, the private sector banks, they're trading more in line with historical averages. Same probably true for the consumer sector. But there are a lot of others that are very expensive. But you can find those bottom-up opportunities, public or private. I would say these are probably the two markets where we're looking to increase our exposure from where we are. And then Japan historically has not been a market for us because we haven't had a presence on the ground, but we find structural changes there being attractive, have started stepping into that market, and we'll look to see how we can do more there. Initially more with partners, and then see if we can do it more ourselves.
That's great. Bob?
Well, if I go to the micro and to the macro, on the micro side, on the security selection, keep in mind that we have a systemized process. And so it's a very diversified portfolio that's sort of continually reassessing all the time the highest expected returns across a wide range of equities. And so we're really just continuously trying to build the best cash flow stream that we can from a set of equities. And so we're not really making tactical bets on sectors or anything like that intentionally. It's really that generating that quality cash flow stream. Most of what you're referring to occurs at the top down. It occurs through the macro, which gives us a great lever, really to shift exposures around the world very efficiently. And on that count, we're transitioning from a world which was really bad for North America and Europe, where we had a tightening of monetary policy and we were doing quite a bit of hedging through that environment. But where in Asia, you sort of have a free runway, right? Because coming out of COVID, they had a weak economy, low inflation, they really need to stimulate. So, but we're coming out of that environment to where we're really achieving more equilibrium conditions across countries. And so we're really removing the hedges. For the most part, we're not really too much hedged anywhere. and really running a broadly diversified global exposure.
Great. With that, we'll bring it to a close. Rohit, thank you so much for your time. It's a great opportunity to be here in Singapore and have a chance to sit down with you. And I hope it's not the last time we do so.
Oh.
And Bob, as always, thank you very much.
Good. Thanks, Jim.
Thanks, Jim. Enjoyed that.